Good afternoon, fellow traders. Welcome to another webinar in the Blue Sky Forex webinar series. Today's topic will be the RSI. Does it work? Can you use it? How can you use it to your benefit? And we'll also talk about some more general things like risk management, etc., as per standard. Okay. So while the last few people are connecting to this webinar, let me just quickly go through the disclaimer. Meanwhile, just write in the question section whether you can properly hear me and see the presentation as well. Contents of this material are provided by third party, not Hot Forex, and are for informational purposes only and do not constitute investment advice. Hot Forex and Blue Sky Forex assume no responsibility for any potential errors, inaccuracies, or omissions in this material. Nothing in this communication contains or should be considered as containing an investment advice or an investment recommendation or a solicitation for the purpose of purchase or sale of any financial instrument. Any views or opinions presented within this material are solely those of the author and do not necessarily represent those of Hot Forex unless otherwise specifically stated. Currency trading may not be suitable for all investors as it carries a high degree of risk to your capital. Trading such products is risky and you may lose all of your investment. Past performance is not indicative of future results. Poor fill rates, expiry times, market volatility, and platform errors could result in losing trades. Before deciding to invest in currencies, you should carefully consider your investment objectives, level of experience, and risk appetite. You should be aware of all the risks associated with foreign exchange and currency trading and seek advice from an independent financial advisor if necessary. So with this out of the way, can you just briefly confirm in the question section whether you can properly see the presentation and hear me as well? Okay, excellent. Thanks everybody for the confirmation. Right, so our agenda today, as usual, first of all, I will quickly introduce our team. Then we'll talk about and look at what actually is the RSI. Does it work and how to use it, how to apply this to your daily trading activities, and of course managing the risk when using the RSI, and of course at last we'll talk about the dangers when trading in FX. And of course you can write down your questions during the webinar and just ask them at the very end. I will do my best to answer them. If any of them remain unanswered, then don't hesitate to write an email to webinars@hotforex.com and they will be more than happy to answer to any inquiry you might have. Okay. So I am one of the senior traders here in Blue Sky Forex. We are an education, research, and trading group. We are senior traders. We teach various strategies. We have different approaches to trading. We have our own styles. Some of us are fundamental completely. Some of us are completely technical, like me. And we do provide 24-hour trade support and analysis just to help retail FX traders to make better trading decisions. Blue Sky Forex is presenting this webinar on behalf of Hot Forex in order to educate you and help you become highly profitable currency traders. So let's take a look quickly at two market types you will come across during your daily trading activities. The first is trending market, and it is more powerful. Most likely you have heard the expression trend is your friend, which is completely true. Identifying a trending market, however, is a bit more difficult because a proper trending market and proper trending moves, they need to be fueled by significant news in order to be benefited from to the fullest extent. Okay, so in order to properly benefit from a trending market and from a significant move on the trending market, the move needs to be fueled by significant news. Thus, you need to have some fundamental knowledge to understand what is actually making the market move. Is it the news that has hit the market, if there is any at all, or if something else? Okay, so that is the reason why identifying a proper trending market is a bit more difficult. Then we have the mean reverting market, aka ranging market. Okay. That is definitely easier to identify because the price essentially, putting it really bluntly, is bouncing between the nearest support and resistance levels. If you have identified those support resistance levels, you can of course find these levels when searching online, daily pivot points or daily support resistance levels. A lot of different websites do provide this information. It is really easily obtainable. If you have identified the support resistance levels, then you see the price really, moving only between those levels, then you can already determine that the price or the market is ranging. Okay. And of course, mean reverting or ranging market can also be profitable, depending, of course, what approach you take to trading and what is your strategy, what is your style. Okay. Now, the RSI indicator, it's most commonly used on a mean reverting market just to find those tops and bottoms, the overbought and oversold conditions in a ranging market, and then just trade in the opposite direction. It can also be used in a trending market just to identify a possible upcoming reversal if the RSI is showing extreme overbought or oversold conditions in the price. Okay. So what is RSI? RSI is a relative strength index. It is a technical momentum indicator, and it will help you determine the overbought or oversold conditions of the certain asset price. Now, anything above the RSI scales up to 100. So 100 is the maximum and 0 is the minimum. Any number above 70 is considered the price or the asset to be overbought, and anything below 30, just in the other direction, is considered as oversold. Okay, it's really easy to read in a sense. Just keep in mind that if the RSI is very on the upside, it is overbought, and if it's really on the downside, it is oversold. Okay, if the price is oversold at the very extreme, then there is likely a reversal coming up soon, and you can initiate a long trade. Okay. If the price is overbought at the very extreme, then most likely there is going to be an upcoming reversal sometime soon, and you can initiate a short trade. Okay. So, taking this concept and thinking about it, it is really easy and really, really straightforward. The RSI was developed by Wallace Welder, who also has created the parabolic SAR indicator, which is a different type of indicator. I would really recommend you to take a look at it because a lot of traders actually find this indicator very useful as well during their trading activities, just to find the general trends, what direction the general price is moving towards. Okay. Now, considering the level of 70 and level of 30, a very, very simplistic approach, and just to get the idea through, as I explained before, when the price is overbought, you can look for an upcoming reversal and trade short, right? And anything above 70 is considered overbought usually. And anything below 30 is considered oversold. However, if you apply this very simplistic approach that you initiate a short trade immediately as soon as the RSI shows you 70 or more, and initiating a buy trade or a long trade as soon as the RSI shows you 30 or less, it might work out a few times, as you can see on the chart here. Whenever the RSI has been overbought or oversold, the price is reversing soon after that happens. But just consistently using that simplistic approach will not work longer term. Okay, it might work out at some point in certain market conditions, fine, but it will not work out longer term because the price can keep on trending in a certain direction longer and to a very extensive amount of time. So the RSI can show you extreme overbought conditions and extreme oversold conditions for quite a long time as well. Okay. Now, depending on the period you set for the RSI, this will show obviously different things, right? If you raise the period of the RSI, it will be in the overbought, oversold conditions much less than if you lower the period of the RSI. Just a principle towards technical indicators, something to keep in mind, and this is just a general rule that applies to most of technical indicators, that if you do lower the period of the indicator, it will make its calculations based on less price data, okay? And you will have a lot more false signals, and you will make a lot more bad trades if you base your trading decisions just strictly on what the indicator shows you, okay? So setting a too low period for any technical indicator is not really wise. Quite a frequently used period for the RSI indicator is 14. Some use 21, and it all depends on the personal preference and whatever strategy you use and how you incorporate the RSI to your daily trading activities. Okay. So what to take away just from this brief explanation this far? Trading simply at the overbought and oversold conditions when the RSI shows you them immediately is not really wise and does not work longer term. Okay. So just a question then, does it work at all? There are two answers, yes and no. The answer, yes, is justified by looking for certain patterns in the RSI indicator, and of course using other variables like price action, perhaps incorporating on other indicators when making the trading decisions along with the RSI indicator, then definitely it can become useful, and it is a viable option to use as a very simple indicator to make trading decisions upon. Okay, and we are going to take a look at three of these methods, how you can apply the RSI to your daily trading. Okay, we're going to look at divergences, we're going to look at midline crossovers, and so-called failed swings. All right. The other answer, no, is also valid because it is the calculation for the RSI is based on history data. Essentially, the RSI is lagging somewhat. Like any lagging indicator, so to say, it needs to be taken or used with a pinch of salt. So really, really carefully, you cannot base your trading decisions solely on the RSI, okay? Because as mentioned before, the RSI can remain in extreme overbought or extreme oversold statuses for an extensive amount of times, okay? Especially when the move is driven by major news. So let's take a look at the very first method, which I find the easiest to find on the price charts. It is easiest to identify, to my mind at least. And certainly it is effective as well. Like with any solid conditions to consider when making your trading decisions, there are always exceptions. Nothing works 100% of the times. Okay, so that is something you need to keep in mind. There is no holy grail. There are tools that help you make better trading decisions, RSI being one of these tools, just a technical indicator that helps you make better trading decisions. How you use it is completely up to you. We'll just provide you with some methods to use, but none of the methods that you will find anywhere will guarantee you 100% accuracy. Okay. So with this in mind, how to identify divergences. Now we're going to observe the divergence between the RSI and the price itself. Okay. So a divergence means that one is moving in one direction and the other is moving in the other direction. You know, it's diverging. Okay, it has diverging endpoints essentially. So a divergence between the price and the RSI can be observed as follows. You see that the price is creating higher highs. You see you have this one top here and it's moving down, then it's creating a higher high point. It's going down again, then another high, etc. So it's creating higher highs, essentially moving upwards. Okay. So the top points of the price fluctuations, they are moving upwards. As you can see here, the wicks are going steadily upwards. But the RSI is showing a different thing. On the RSI, you see exactly the opposite. It is actually creating lower highs. Okay, so the tops are going steadily lower and lower and lower. And at some point, you will just see the price completely reversing and going in the other direction and starting to trend in the other direction as well. Okay, so quite simple. You will find this kind of formation on the charts quite often. And it also works the other way, right? This was an opportunity for a bearish trade, and this is an opportunity for a bullish trade, okay? So if you see the price creating lower lows on the price chart, but on the RSI, you see it creating higher lows. So the bottoms of the fluctuations are going steadily higher. So you see a divergence in the movements of these lows, okay? And at one point you will see this completely reversing in the other direction, okay? So how to initiate a trade based on these divergences? Something you can do, you can also see this on the RSI here, that as it is creating on the bearish divergence, as it is creating these lower highs consistently, at the point the RSI is crossing the 50 line, okay? You see, as it is creating these lower highs, but it is staying still on top of the 50 level, right? Okay, so as soon as the RSI crosses the 50 level, then you will go short. Okay, so your trade will happen somewhere around here, if you can see my cursor on the screen. Okay, and trading short here would yield a relatively decent gain for you. The same goes on this occasion. As you can see, as soon as the RSI crosses the midline, it would be a relatively good point to enter the trade and just go long. All right. So it's not a solid condition, but it is one of the conditions you can use to enter a trade when you have identified a divergence between the price and the RSI. Just one of the options, one of the methods you can use. Okay, I have another complaint that they cannot see the slides. Let me just pause the sharing of the screen and share it again, because sometimes something weird happens, and for some rare users, the screen is not shown. It should be showing right now. I hope it is. If it's not, then there's really not much more I can do. So let's continue to the next slide now. Right, so midline crossovers. Okay, so this can be a bit controversial topic. There can be a lot of debate for it. I personally don't find this the most effective way to use the RSI, because in a heavily ranging market, and if the price is really consolidating into a narrow range, then you can see the RSI crossing the midline quite frequently. And you will see this more happening on the lower time frame charts, like 1 hour, 30 minute, 15 minute, even a 4-hour charts. Okay, so I would recommend only observing this method anywhere from a daily chart and upwards. Okay, just to actually find some good maybe end of day or end of week trades. All right. So the simplistic approach with this one is you just go long as soon as the RSI crosses the midline, like you see here. You have like 2 or 3 or 4 consecutive bullish days here with this asset as soon as the price crosses the midline of the RSI. The same as it comes back down, you have definitely a very solid bearish day here. Again, when it crosses back up, you have a significant move upwards, and the next day is also bullish, etc. Okay, this is a daily chart, right? So only attempt to use this on a daily chart and upwards. I don't recommend this on a very lower time frame charts. Okay, so please keep that in mind. Just a very, very simplistic alternative approach to using RSI in your daily trading. Now, the last method, it is perhaps most complicated because the conditions are really, really precise, and the conditions need to be followed extremely accurately in order for it to be a valid setup and in order for it to most likely end up in a positive trade. Okay, and this is called failed swings. And on this example, we're going to examine a bullish failure swing. Now there are 4 conditions to keep in mind. And again, you need to be extremely accurate with this, okay? So you see the price being bearish, it is moving downward somewhat. And the RSI is also coming from top to bottom. Just ignore this small dip here, that's fine. But what you have to pay really close attention to is that the RSI is moving from higher to just below 30. It touches the 30, it can move just a little bit below 30, and it bounces back up, okay? So it bounces back up just to around 40, okay? Maybe 41, 42 or so. So essentially it comes back down, it bounces off the 30, it just pierces it a little bit. It comes back just almost to the center of the 50, the midline, and the 30 line. This on its own repels the RSI back down to nearly to the 30 level again. Okay, but the very important thing to keep in mind that it does not go below 30, it just stays a little just above the 30. Okay, if it does not break below 30 again at this point, when it comes back down to the RSI 30 level the second time, when it does not pierce it but bounces back up again, and on its way upwards it pierces the level 40 or 41, 42, and then you have a bullish failure swing because it failed to go to the oversold extreme, and you have a price reversal and it's going to start its bullish movement, a bullish wave upwards. Okay, so let me just go through this again really quickly. The RSI comes down to 30, pierces it just a little bit, bounces back up to 40, then goes back to level 30 but does not pierce it. It stays just above that a little bit, and as soon as the the RSI goes back up to the 40 and pierces it, you can initiate a bullish trade. Okay, so it will create this W formation with the RSI. Okay, so if you see a W with all the conditions that I mentioned are met, then it's a good trade to go bullish. All right. And it's vice versa with a bearish failure swing. It does create this kind of a NEM formation of the RSI. So the conditions are exactly the same, but just with the level 70 and 60. It goes from below 70 up to 70 and pierces it a bit, then comes back to 60 or 58 or so, goes back to 70 but does not pierce it anymore, and it simply immediately bounces back down. It pierces the 60, and then you can initiate a short trade. Okay. So this is called the failed swing. Now we're not going to open up a live chart to look for this failed swing, because it is relatively difficult to identify, because the conditions of this method, they are extremely precise. However, if you identify this formation and the conditions do meet, then you have stumbled on a really, really good opportunity to initiate a successful trade. All right, so definitely something to keep in mind. The easiest to identify out of these three methods, well, obviously you will see the midline crossovers the most, because it is happening all the time. But the most effective way, to me at least, and the most efficient way that you can identify the easiest and find a lot of opportunities is the divergence between the price and the RSI. Okay, because divergences between indicators, we actually have a different webinar just focusing on divergences between indicators as well. Divergences between indicators can really be a quite powerful tool in helping you make good trading decisions. Okay. So we have discussed these three methods. You can definitely watch recording of this webinar on the past webinar section on the HotForex website, just to remind yourself of these three methods. Now let's talk about managing risk. Okay. As per standard, we don't really recommend beginner traders use a reward risk ratio higher than 1:1. This means that your stop loss and take profit levels are equal in distance from your entry. Let's say your take profit level is 30 pips from the entry price, and your stop loss will also be 30. Now, if you take it a step further, and if you consider yourself as an intermediate trader already, you have some experience on the market, then you can apply already a reward risk ratio of 2:1, which means your take profit level is 2 times the distance of your stop loss. So if your stop loss is 30 pips, then your take profit is 60. Okay, so essentially you are increasing the potential rewards while keeping the potential losses the same. Okay, now something to keep in mind and be really careful is not to raise this level too high. Anything above 5:1 is already extreme. The best traders trade with a risk reward or reward risk ratio of 4:1 and 5:1. Anything above that, you will render your trade not ever reach your take profit level. Before reaching your take profit level, the price will reverse and you will hit your stop loss instead. And in the rare cases where your trade will hit your take profit, you have generated too many losing trades for this one profitable trade to make up for the losses. Okay, so you have to be extremely careful, understand your own trading habits and trading styles, and apply appropriate reward risk ratio. Don't overdo it. Start with 1:1 and then take a next step and move to 2:1. And if you do get really good and you consider yourself more towards the professional trader, and you have been able to generate somewhat consistent profits on your trading account, then you can use maybe 3-to-1 or 4-to-1. Okay. So the next thing you can apply is dollar cost averaging. Now, most of you have heard of martingaling, right? It's essentially doubling up your position on the same asset in the same direction in the hopes of each and every consecutive new trade to make up for the losses of the previous trade and eventually ending up in profit. Okay, but the market can remain trending in certain direction for longer than you can remain solvent with your account capital, thus martingale being extremely dangerous. Too many accounts have been emptied due to martingaling, along with one of my first accounts when I was just starting out. Martingale seemed really tempting. It was one of the first strategies that I found online, and surprise, surprise, I emptied my account extremely quickly. So most of these professional traders have made mistakes in the past. You know, they have been in the same shoes as most of you are at the moment. Instead of martingaling, you can apply a more softer approach. It is a bit similar to martingaling, but let me explain how this one will work out. Let's say that your standard lot size that you use mostly for each and every trade you initiate is 1. Okay, so lot size of 1 is the lot size you usually use. Now, instead of initiating one trade with a lot size of 1 on one asset in one direction, you will first start off with initiating a one trade with a lot size of 0.3. Okay, so if you see the price moving against your desired direction, at some point, let's say after 15 pips, you initiate the second trade on the same asset in the same direction, again with a lot size of 0.3. Okay, now you have 2 trades ongoing with total lot size of 0.6. So if the price still goes against your desired direction, you initiate the third trade on the same asset in the same direction, but with a lot size of 0.4. So in total, you are still trading with lot size of 1, but you have 3 trades open instead of 1, and each and every new consecutive trade has a better entry price. You are thus spreading out the average entry. You will be able to gain higher profits if at one point if the price reverses and will go in your desired direction at one point. And if the price still continues against your desired direction, then you have lost less money with that trading sequence. So you're risking, in terms of lot sizes, you're still risking the same amount, but you are averaging out your entry price, and this can longer term raise the total profits that you can earn. Now, really important thing to keep in mind with dollar cost averaging is that if your initial trade accuracy, that means if your very first trading decision is really accurate, let's say anything above 65%, so 65% of the times you will get this right on the first trade. Okay, in this case, dollar cost averaging will actually erode into your profits, and this is because you have initiated the first trade with a lower lot size than standard. Make sense? So if you are a really accurate trader, dollar cost averaging is not really suitable for you. However, if your initial trade accuracy is around maybe 50-55%, then dollar cost averaging can really help you benefit more and earn more profits longer term. Okay, so keep that in mind. If you are an accurate trader, don't use dollar cost averaging. If you are not really accurate with the first trade, then go ahead and practice this, and you will definitely find this a useful tool. Okay. Another thing you can use are trading stops. Okay, we also have a different topic and different webinar for trading stops where I show you how to apply one. and how to use one, maybe some few tips and tricks as well. Trailing stop is useful when you are not behind your workstation or behind your tools to actually manage the trade after you have initiated this. Now, managing the trade will only be or come into play when you are a longer term trader, because if you're aiming for, let's say, 500 pip gains, then obviously you want to adequately manage your trade, just move the take profit or move the stop loss closer to the entry price after you have already earned some profits. But if you are a shorter term trader, like a scalper, then trailing stops will not really be something to consider, because if you do apply trailing stop to around maybe 5 pips from the entry price, even the smallest price fluctuation will make you hit that trailing stop loss. Okay, and with scalping you are aiming for this maybe 15, 20, 25 pip gains, so applying a 5 pip trailing stop will not make sense. All right, if you're a longer term trader, definitely use a trailing stop. If you cannot be behind your machine, or if you don't want to manually adjust the stop loss, if you're a short-term trader, don't use a trailing stop. Okay. Now, a few things to keep in mind regarding any dangers when you are trading. Please do not trust bots, because most of them are designed to generate losses on your trading account. Please be extremely careful. If you want to try out or test out any expert advisor or any bot or robot that initiates trades on behalf of you, then please do so on a demo account extensively, maybe 3, 4, 4, 5, 6 months. If you see consistent account growth on a demo account for this extensive amount of time without any large drawdowns, then please go ahead and consider, setting it live to a live account. But in this scenario, you would still definitely need to use low lot sizes just to trade as safely as possible. Okay. Now, sad but true, only 5% of the retail traders make money in FX longer term. And the general reason behind this is just human psychology. Okay. 95% of the retail traders just can't handle it. They can't handle the stress. They can't handle the chemical reactions that are happening in the brain when one is on the losing or a winning streak, and stupid mistakes are being made, thus generating significant losses on the account, eventually emptying the account. And of course, then what happens? The trader is considering trading as a scam and moves on, right? They will never look back. Mistakes have been made. Okay, 95% of people are like that. The 5% of people who are actually successful and making money in FX, these are the ones that are persistent. I'm quite sure that all of the traders among those 5% have also made mistakes, emptied maybe 1 or 2 accounts, but they have been persistent enough to evolve, educate themselves, learn, analyze themselves, what they actually did wrong, improve, and do better, right? So these are the 5% of people who actually want to succeed and see trading perhaps as a good opportunity to evolve their own skills, try something new, and actually earn living while trading on a workstation. Okay. With all this in mind, I want to mention that blowing up one or two accounts is definitely not a bad thing. It's just a learning curve. Trust me, even the professional traders have been there. They have also emptied 1 or 2 accounts, maybe more, during their learning process. So if you have emptied 1 or 2 accounts, it's a sign, it's a signal that you need to change something. You need to change a part of your strategy. Whether it be money management, whether it be the technical indicators you consider for your trade entries, whether it be your risk management techniques, whether it be the session you're trading in, etc. You need to change a part of your strategy. I don't recommend just jumping from one strategy to a complete new strategy each and every time it fails or doesn't work out. This way you will be indefinitely looking for a strategy that suits you. Okay. We do also have a webinar about strategy, what it is and how to develop it and what it consists of. But just briefly, you need to develop a strategy yourself because every trader is different. If you find a strategy online that has been tailored by that certain someone to meet their own personality and their own technique, it's 99.9% that this strategy will not fit for you. Okay, at least one part of it does not fit for your um, trading style or method. So you need to tailor your own strategy based on your own technique, your own emotional control, and what approach you do yourself take towards trading. Okay. So you can use other strategies as a template just to build your own on top of it, but ultimately you will still need to design your own strategy yourself. Okay. Blowing up one of your accounts means you need to change something. Just change one bit in your strategy, test out how a different aspect of that something you change works out for you until you find something that works for you. Okay. Last but not least, just want to mention that 5% of the signal services and signal rooms are legitimate. So please be extremely careful when you decide to test out one of them because, as mentioned, they most likely will not work out longer term. Please ask for a proper audit trail and performance record. If you can approach any other users of the same signal service or signal room, ask for their own experience, ask how this has worked out for them. And if you have positive feedback, then set it up on a demo account for extensive amount of time. If again you see consistent growth of your account capital without any large drawdowns, then you can set it up live. But again, please start with really, really low lot sizes just to be as safe as possible. Okay. So this is it for this webinar and this topic. I will now take questions. Let me just open up the question section so I can pick those up. Okay, Sabestaki is asking, can you please mention some support resistance level indicating website names? Sorry, can't really bring up any out of for legal reasons, but what you can do, you can just use Google, type in daily support resistance levels or daily pivot points or daily pivot levels. Trust me, you will get a lot of responses, a lot of websites that you can just tap into, and a lot of them have either the same or really similar levels that they have determined as the 3 nearest support or resistance levels. Okay, really straightforward. Don't hesitate. Faraz is asking, can we use any other indicators to reconfirm the RSI trade confirmation? I understand you're asking if you can use any other technical indicators in conjunction with the RSI for trade entries. Of course, you can use actually any technical indicator with any other technical indicator just for additional confirmation of a certain price condition, right? That's not a problem. Perhaps one of the two of the most commonly used indicators used with an RSI, one of them is perhaps Bollinger Bands. Just if the price reaches the top Bollinger Band and the RSI is also showing the price in an extreme overbought condition, then maybe it's a double confirmation to go short, right? Something like that. This is an approach you can apply with the Bollinger Bands and the RSI. Another indicator is the stochastics. That is also an overbought, oversold indicator. So if stochastics is also showing an overbought state while the RSI is showing the same thing, then you have a double confirmation, perhaps for an upcoming reversal or a short trade. Okay, so perhaps look into using stochastics or Bollinger Bands along with the RSI. Sabasaki is saying about a bullish divergence being on the failed swings chart as well. Yes, there is a somewhat of a bullish divergence because you see 3 points being going higher on the RSI, but these lows going lower on the price chart. Yes, really accurate and good analysis. You have a good eye. Well done. Yes, this is a bullish divergence. Although there is also a failed swing happening here, so this is just a good example to show, yeah, both of the formations in action on the same time even. Good spot. Okay, Sabasaki is also asking, if I pronounce your name incorrectly, then I apologize. But you're also asking, please recommend RSI period and levels as per your experience. Right, sure, I can provide you with some recommended levels, although what I want to mention prior to that, then that each and every one of you will need to determine what works best for yourself, right? It's like tailoring your own strategy, because what works for me doesn't necessarily work for you, okay? Now, for me personally, the levels of 70 and 30 on the RSI, they are not strong enough for me, okay? The RSI levels that I personally use are 85 on the top side and 15 on the lower side, okay? So these are the levels that I use on the RSI when I do my own technical analysis. And the period that I use for the RSI is also the very default period of 14, okay, 14. If dealing with an extremely volatile market, then I raise it up to 21, okay? And if I see a really slowly moving market, then I lower it down to 9, but I never go above 21 and 9. And this is me personally. Some people use a RSI period of 36 as well. I don't really see a necessity of using that high period for my own trading. But yeah, 25, 14, or 9 will be the levels for me. Abdul is asking, what is the RSI secret winning point? It's a good question, but there is no good answer. Sorry for that. There is no secret point on the RSI for winning, because the RSI is just a technical tool. It's a technical indicator that will show you the price condition, whether it is overbought or oversold. And as mentioned previously during the webinar, that the price can remain trending in one direction for quite an extensive amount of time. And when this happens, you will see the RSI being in an extreme overbought or oversold condition for an extreme extensive amount of time as well. Okay, So there is no secret winning point 2 on RSI. Sorry. Martin is asking, is RSI history-based indicator based on algorithmic economic events? The RSI moves and calculates its movements based on historical price, and the price that it considers in its calculations is based on the period you enter into the parameters of the RSI. It has nothing to do the fundamentals. It has nothing to do with with any algorithmic economic events. Nana is asking, can you figure out divergence without indicator? Okay, let me just explain what the divergence is. Divergence is a diverging action or an action that goes in a different direction from another action. Okay, so let's say we have two cars. Okay, one is driving in one direction, the other is driving in the other direction. They are diverging. They're going in the opposite direction or in the other direction. Not necessarily opposite, but just they're not coming together, but they are going apart. Okay. This is a divergence. You cannot analyze a divergence without two parties, two or more parties. You have to have two parties at least. Because if you take a parameter or something that you can visually analyze, and if you want to analyze a divergence, you have to take something else, some other parameter to analyze the divergence against, right? So you can't do it without a second parameter or a second indicator, okay? You have to have always two parties to analyze. Abdul is asking, what is the RSI best period? There is no best period with any technical indicator. There is just a default one that is 14, and a lot of people use that. And yeah, it works out well, fine. But depending on your trading style, depending on how you use the RSI, any period can be the best period for you, right? The best technical indicator period. So you should go ahead and test out different values to see what works best for you and your trading style and strategy. Caleb is asking, do you have to match the RSI period to a specific time frame? No, you do not have to do that. If you use the default period of 14, for example, you can use that on a 5-minute chart. You can use that 1-hour chart, daily chart, weekly, yearly, doesn't matter. Okay? You can always keep it at 14 if that works out for you. If your strategy has maybe slightly different conditions based on the time frame, then obviously you can adjust the RSI period based on the time frame charts you are using. If you're switching between them, then you also need to switch the period of the RSI. Rodrigo is asking, is the webinar going to be on the recorded webinar list on the website? We always record the webinars, okay? And the past webinars that are recorded have already been posted on the past webinar section on the Hot Forex website. And I'm quite sure that there is already a webinar of the same topic uploaded there. And you can just pick it up after logging in and going into the past webinar section. Okay, a last call for any additional questions. Sabasai is saying the failed swing can also be seen on the naked chart too, and not necessarily. As the conditions of the failed swing, they are taken from the RSI indicator itself, then you cannot really, with an eye, by visual analysis, just a price chart, you cannot really determine the values of the RSI if you don't analyze the RSI itself. So you should still have the RSI open if you want to find any failed swings formations. Netson is asking, are you sending the slides to us? Sorry, these slides cannot be sent out from our system. If you want to revisit the slides and the actual topics of the webinars, then please check the past webinar section. Thanks for the good feedback. Okay, as I don't see any additional questions coming in at the moment, then again, thank you really much for attending today's webinar. I really appreciate it. It was my pleasure being the host today. I wish you a good rest of the day. Trade safe and take care. Have a good day.